welcome to the panel discussion that's going to address one of the most critical questions of our time. Will the crisis that has dogged Europe for much of the last 2 years return? I'm John Pedersen, the General Counsel for Credit Suisse in Asia, and it's a privilege to introduce our panelists this morning. Lorenzo Bini-Smaghi, the former member of the Executive Board of the European Central Bank and a visiting scholar at Harvard's Weatherford Center for International Affairs, and now apologize for my Italian here, the Istituto Internazionale Affari. And also Dr. Matthew Burrows, Counselor of the National Intelligence Council and Principal Author of the NIC's report entitled Global Trends 2030, Alternative Worlds. Our panelists will discuss one of the defining questions of 2013. Has Europe managed through the worst of the lingering crisis, and can it now focus on building a new and stronger foundation for the Eurozone, or will the crisis return in full force again? We know the crisis has proved very resistant so far. Mario Draghi, President of the European Central Bank, pledged to do whatever it takes to protect the Eurozone from collapse, including fighting high government borrowing costs. And since that comment and some concerted central bank action, Europe has started 2013 on a note of optimism. But now this optimism may turn out to be only a brief respite following the results of the recent Italian elections and Britain's loss of its AAA credit rating, and obviously the events of Cyprus over the last few days. The upshot is renewed unease about Europe's still unresolved debt crisis, which once again is casting dark shadows of over the stock, bond, and currency markets. The experience and expertise of our panelists will be invaluable in helping us to understand the forces shaping European politics and policy today. Ladies and gentlemen, please join me in welcoming our panelists and our moderator, Helen Howarth, who is the head of European interest rate strategy at Credit Suisse. Helen, over to you.
Thank you very much, and good morning, everybody. We've obviously just heard a very, very interesting, insightful speech from Monsieur Trichet, focusing on the European situation. Clearly, when you're scheduling these events in advance, Europe's a bit of a challenge because you're not quite sure when the conference happens, whether you're going to be in one of the calm periods or in the midst of the latest storm that seemed to characterize Europe over the last few years. And I think very much when you look at trying to follow what's going on with the markets, and then fundamentally what we seem to be getting is very much a situation characterizing a crisis where you get a period of extreme market volatility, followed by a policy response, followed by some calm. Then you get sort of imbalances increase again, another bout of market volatility, and then the whole thing repeats. And the question right now, as we stand, given, as has been said, the inconclusive Italian election results, the vote yesterday in Cyprus not to accept the depositor haircuts that have been proposed as part of the bailout for Cyprus, is, are we standing right now perched on the edge of the next one of these bouts of volatility, or is this yet just another step as we sort of proceed further through this process? I think it's fantastic today in terms of the panelists we've got. Obviously, directly on my left, Matt Burrows can give us very much the transatlantic view, in addition to his current post at the NIC. Some time back in the 80s and 90s, he worked for the CIA, covering Western Europe, at the time looking at the development of some of the European institutions. So I think we'll get a very, as I said, transatlantic and different view in terms of what Europe needs to be doing. It's a question that's often sort of absent from some of these panels. And then Lorenzo Bini-Smaghi, on my far left, now that he's no longer at the ECB, he has the luxury of being able to step back and look at what he thinks of the policy decisions that are being made, and I've no doubt he's going to offer us some invaluable insights into some of the developments recently and looking forward. With that, I propose I was going to give each speaker a few minutes, 5 to 10 minutes, to open the discussion and give us some background comments and remarks, and then I'll open it up to questions. Do you want to sum up?
Yeah, well, thank you very much. Thank you for being here. I look forward to what the former ECB and the former CIA officials can say about the current situation. I think you have a privilege to have both views. I think if you go back 1 year ago, it may sound like a century ago, but we were discussing whether Europe would break up. The restructuring of Greece was under discussion, and the elections in Greece were the key factor. I think that this has led to a major changing point during the summer. You have mentioned the ECB's famous sentence, maybe one of the sentences which will go to history in terms of central banking policy. But I think there are other issues which took place during the summer which made a change. First is the result of the elections in Greece, whereby the Greeks in the end were put in front of a choice. Do you want from tomorrow your accounts to be denominated in drachmas, or do you want them in euros? And finally, they saw the alternative. They watched over the cliff, if you want to use a US term, and they decided to step back, and that maybe the euro was better. They knew that it was painful, and it will continue to be painful, but ultimately getting out of the euro and getting back to a national currency is not only a very complicated phenomenon, it is also does not necessarily lead you to do the kind of things that an economy like Greece has to do, which is to fundamentally change, restructure, and reform. So ultimately they decided to stay in, and they voted twice, and ultimately they got a government which started to get back on track, which didn't happen over the previous 3 years. A large part of the problem during the crisis until last year was the fact that the Greek government thought that we could continuously renegotiate part of the deal. The second factor is, of course, the central bank sentence that they will do whatever it needed within the mandate. I think that's part which is often forgotten. And the third point, which is also important, is the German attitude, that they realize that it's not in the interest of Germany to have a country like Greece getting out. They understood that following a first instinctive reaction that, if you can't make it, why don't you stay out? That was, I think, the initial instinctive reaction. Had Greece fallen away from the euro, this would have been a dramatic situation, not only economically, but also politically and socially, at the heart of Europe. And Germany would be blamed. Like it or not, Germany would be blamed. And I think this would have been a major problem for the future of Europe and for the future of Germany within Europe. And I think Merkel understood this. That's why she went to Athens. That's why she supported the ECB's decision, in spite of the opposition of the Bundesbank president. So the environment at the end of the summer, I think, was really a turnaround. And you have to look at all these dimensions on top of the changes which had taken place within each country. Now, the problem is that when things get in the pendulum, when things get too good, something else must happen, which goes in the opposite direction. And what happened is that in many countries, I think including in Italy and Spain, the opportunity to apply for a program and to really lock in all the reform process was not seized. And for reasons of pride, and that's part of democratic process, I think, that's part of politicians' instinct that they want to be seen as being able to do things by themselves without the stigma of the IMF or European Union. They thought that Italy and Spain could then surf with the wave of the ECB. And so they decided to continue without having a program. And of course, life is not always as easy. And Italy in particular had to face an election. And then the result of the election, which is even worse than the election, because the result is that we don't have a government. We have a hung parliament, a hung in terms of there are three parties. The vote was a vote against the establishment, against the pain of going to reforms. So a bit of a populist result, and it's going to be complicated to get out of this situation and try to get back on track and continue to do the kind of reforms that are needed. So 1 year back, we had some positive developments, taking the pendulum away from the extreme scenarios like exit of a country and potentially disruptive consequences for the euro, to a much more favorable situation, but maybe it's too favorable, and complacency has spread among politicians, and this complacency is creating a lot of unease and uncertainty, and maybe the pendulum will shift back toward more tensions, more instability in the markets, and of course what happened to Cyprus these days, even including yesterday, where there is a sense of, again, complacency that parliaments can vote against a solution, and so this will lead to keeping banks closed for another day. And although my personal view is that from a financial point of view, the contagion element from the Cyprus decision is not that relevant, in the sense that Cyprus is really completely different from any other country, we should not forget the psychological element, in the sense that if banks remain closed, people will queue, televisions will film people queuing, and this is one of the scariest things all over that will be seen all over the world, and this will scare people. And that's a bit my concern. I remember after Lehman Brothers or after Northern Rock, the filming of people waiting on the list, on the doorstep of the banks, waiting to cash in and being interviewed and saying how desperate they are, they cannot get their cash, creates a sense of anxiety all over the world. And this may, at a certain point, create some contagion to other parts of Europe, and this will have to be managed very, very carefully. So we are not back to where we were 1 year ago in terms of tension and anxiety, but there are elements of renewed instability which suggest that there is a long way to go for Europe to get out of the crisis, because so many things have to be done. I think Trichet mentioned some of them earlier, but to change and to change the structure of our economies, especially in the south of Europe, and to better integrate these economies in a global economy, as others have been able to do, will take time and will take some pain. I think I should stop here maybe at the beginning.
So, Matt, would you like to make some comments?
Yeah, I think, Lorenzo has said very eloquently that, when you're thinking about this crisis, you shouldn't think about just one pivotal moment, and that we have to keep in mind it's going to be a long, extended one with different phases, and maybe we have gotten through, thankfully, the first phase of high degree of crisis, but that the crisis is going to go on, and that this is really a very, in the end, it could be a very transformational crisis for Europe. And I say that because I think there's a great deal at stake here, not only for Europe, but also for, as we've talked about, the transatlantic relations, but more broadly for the world. We've talked about in other sessions, the plight in some way of advanced economies. So you have an aging phenomenon, obviously, in Europe, but you also have that in Japan. You also have that in the United States. And that's going to, in some ways, complicate the resolution of the crisis. Because I think there are some, there's going to have to be some give and take within societies. So you're talking about really cutting back on some of the social entitlements, extending retirement ages. This is not just an argument going on in Europe, also it will be in the United States. When we wrote the long-range analysis, which Helen mentioned, which we call alternative worlds, we talked about 3 different scenarios for Europe. And first one was collapse, which I think even when we were writing it, this was last year, was really going out the realm of possibility. But we have two other scenarios. One was of slow decline, and that's where Europe doesn't take the next steps, the steps that Monsieur Trichet is talking about in terms of structural reforms, in terms of completing the single market, more competition in the service sectors, more labor flexibility, and I think also ramping up the sort of R&D education element, the things that were laid out in the 2020 vision. So that is if that doesn't happen, I mean, we could see Europe on a slow decline. And in some ways, the fact that you have an ongoing crisis may be helpful in keeping people focused on just the need for reform. The other scenario that we had there was Renaissance. And again, Europe has this ability certainly to flip itself and right what is wrong, begin again, in a sense. And that capacity, I think, is there, but it's going to be a very long time to get there. In my own mind, as going back to this theme of crisis, I think actually it can serve as a very good motor, and when you compare it to possibly what we have in the States, which we have this lucky element now of shale gas and oil, which is going to, I think, relieve some of the pressure on some of the structural reforms that we should be taking. And in that sense, I'm not sure it's going to be helpful. But where you do have crisis, and where you have this at a level that's manageable, so that you actually get societies talking to one another, beginning to take these steps in which there will be sacrifices. I think that actually have a huge payoff. The final thing I mentioned at the very beginning, there's a lot at stake here, not just for Europe, and just not for the global economy either. I mean, when we're writing reports, as we've done, and looking at this in a large sense, in terms of security, global security, I mean, Europe has performed huge tasks in terms of providing security for the rest of the world. If you think after the end of the Soviet Empire, the integration of Central Eastern Europe into the European Union, we now have a similar situation of potential instability on the southern rim of Europe. Here again, Europe can play a role, but Europe probably really only play a role once it does resolve its crisis. If it is on this trajectory of slow decline, it's more likely it will turn inward, and that has, as I say, huge implications for all of us. So with that, I'll turn it back to the moderator, Helen, to get the Q's and A's started.
Okay, thank you very much. A lot to think about just in those few minutes. I'm going to open up to questions. There should be some microphones.
Can I say something on
please.
What Matt said? I find this analogy this categorization very interesting: collapse, decline, and renaissance. And just two observations. Had you made this analysis 10 years ago, where would you have put Europe and some countries in Europe? For instance, in the early 2000s, where would you have put Germany? Not in the Renaissance, probably, but in the decline. And where would you have put Spain? In the Renaissance. Now, 10 years after or more, everything changed to some extent. If you look within Europe, because Europe is not all the same because of all this transformation, you would probably put Spain in the decline and Germany in the Renaissance. And indeed, if you go to Germany, it is more successful, I would say, than the US and than many advanced economies, because it has been able to change. And Spain is in a very hard time and decline. So things may change relatively quickly. And even if you go within countries, I was in Spain last week, and indeed you see that it is a country which is suffering. But then I realized there are 3 of the top business schools in the world are in Spain. 2 in Madrid and 1 in Barcelona. And I was noticing this. And so even in a decline, there are elements in the society which are changing. And I think that's one important aspect we should not forget. That, and I could quote many other examples, even within Italy, of companies or sectors which are doing relatively well. It is the growth. I mean, it's much more difficult to change because some of these are cultural changes in terms of relationship between the unions, companies, and this in Europe is always a bit more complicated than elsewhere. But history shows that these things can change relatively rapidly to some extent.
No, totally agree with that. In fact, I think, you know, the one thing we did notice with Germany 10 years ago is it was taking the structural reforms that could lead to a renaissance. And you can see some of that now in Spain happening too on the labor side.
Okay, thank you very much. In terms of the Q&A, if you have questions, if you want to direct them to a specific speaker, then please do. I'm going to take the opportunity, since I'm sitting up here, to kick it off. There's been, you've talked already about sort of the immortal words that have been said by Draghi in terms of to do whatever it takes. And we've seen the impact that the announcement of the OMT program has had by the ECB in terms of stabilizing markets. Matt has spoken about the need for crisis for reform. And there's been a fair bit of criticism of politicians and saying, well, and also sort of implicitly the ECB by saying, well, it was actually too much of a good thing. It had more impact than what maybe was helpful in terms of encouraging the structural reforms that Matt has been saying are so essential. I wonder if you might comment in terms of what you think of that criticism, in terms of whether it has any legs. What do you think about the OMT program and these comments, and do you think it'll actually ever get activated?
Well, I would say that, you know, the OMT program came after the previous experience. If you go back 1 year, in 2011, we got close to a very similar, very tense situation during the summer, again because of the debt restructuring of the Greek debt. If you remember, in June, July, the first agreement on the debt restructuring was not fully successful. It only got a haircut of around 20%, 21%. And after a few days, it was clear that this was not sufficient, so new tensions were rising in the markets, affecting Spain and Italy. And then the ECB saw these tensions arising, interest rates going up, and we discussed, that we couldn't really let the situation go because the risk of a vicious circle was there. So we decided to interact with the Spanish and Italian governments, telling them, well, if you want us to intervene, you should at least do something to do your own part and to implement a series of measures in structural terms and budgetary terms. And in 1 day or two, the two governments committed officially to do that. So we started intervening. It was, I think, the 10th of August, and the spreads came down, the calm came back. But after a few weeks, the Italian government started to backtrack and so basically killing all the good things we had done. So that experience, I think, led the ECB last year to say, okay, we will want to repeat this thing. If we intervene, we want a signed contract between the governments and the IMF and the European Union, and they will be monitoring. We won't just base ourselves on announcements. We want a clear commitment, which is, of course, politically more intrusive, and the stigma of IMF is stronger. So this time around, the ECB said, okay, I'm ready to intervene if you do that. And they haven't done it. They have not submitted themselves to a program. And the markets took the positive signal from the ECB and is still waiting for the positive signal from the two countries. And I don't know, it depends a little bit on the markets. If the markets are happy like this, that's fine. I have to say that I would be a bit more skeptical, and if it comes at a certain point, for instance, in Italy, we don't have a government, but if rates start to increase again, if there are doubts in the markets, and we need to apply to an IMF or a European program, that's not going to be very easy, because first, to have a program, you need a government to sign it. You need an agreement with the parliament, and then you need to submit these agreements to your partners. And we know that in 6 months' time there are elections in Germany. And this is an issue which is not going to be going easily. So there's an element of uncertainty that may turn to be a bit critical to some extent. So having waited to be pushed by the markets to apply for a program is not the best of times. But politicians never take tough decisions when they don't need to do so. They tend to look at financial markets with the rear window. When in good times, they think good times will last forever. And maybe some of the markets also think that the good times will last forever. Or at least they think that when the bad time comes, they will be so close to the door to exit first. So it is I think it's a common cognitive dissonance that we all think that we will be in the right seat when the music stops. But unfortunately, this doesn't happen in reality.
Matt, would you like to add?
No, I think.
Okay. Very sensible. Any questions? Front row on the left.
Hi, this is a question mainly directed for Lorenzo. In light of comments made about the structural reforms necessary to make the European project viable in the future, could you talk a little bit about the possibility of tax harmonisation across Eurozone countries in the future? Because this is something that Irish politicians in particular have resisted in the past.
Well, this has been a long discussion in Europe. I mean, especially continental countries, and France and Germany have been pushing for some time. They were pretty upset to have to bail out Ireland, while Ireland has some pretty advantageous corporate taxation. And the issue is coming back with Cyprus. The problem is that tax harmonization is an issue you decide by unanimity. So it's still not a union competence. It is a competence of the member states, which have to decide and agree. And that's clearly, it goes at the heart of democracy, of course. If you start harmonizing taxes, basically you give up a lot of your sovereignty. And so far the sovereignty was given at the level of the budget as a whole, so in terms of debt. But the structure of taxation, whether to tax more labor or more capital, that was left to the choice of the member states. Now we know that some factors tend to move more rapidly and so are more difficult to tax than others. So tax competition is obviously bigger in some parts and with respect to some sectors than others. And I think this will be an issue which will come up, has come up again in Cyprus, because why do you want to bail out a country which gives preferential treatment to certain depositors and wants to be a financial centers beyond his means? So these are issues which are going to be addressed and are becoming more and more interrelated, I think. I have to say that at the beginning of monetary union, at the time of the Maastricht Treaty, there was a deal between the French and the Germans to create a single currency, but also to harmonize taxation. But then the French at the end withdrew from that part of the agreement because they wanted to maintain their own sovereignty. And now, to some extent, they are paying for that. because they would like to be a bit more intrusive in other countries' taxation systems, and they cannot. But okay, you cannot rewrite history, but I think the process of integration in Europe goes step by step, trying to address issues. It doesn't work. Grand designs don't work. People have rejected them. So it has to arise, and the anti-money laundering issue is one, and will be on the table, I think, in the near future, as well as the taxation of capital, because free movement of capital is clearly an element which is distorting the functioning of the capital market in Europe.
Next question. From here.
Yep, sorry. This is another question for Dr. Binny. You said that last summer Germany realized that they could not allow Greece to leave the euro area. Is that the same is the same true for Cyprus?
I think there is an awareness in Germany. I mean, we could talk for a long time. I lived in Germany for 6 years, and it's interesting how the rest of Europe would like Germany to lead more Europe. But we forget that that's not, I don't know if there are some Germans here, and they would explain it better than us, but the whole educational system after the war has not been based on Germany leading politically, for a series of good reasons, by the way. After the war, the US has tried to avoid Germany playing too big a political role. But now, this is the reality, that you have a biggest economy, and the biggest economy cannot behave like Switzerland. It cannot be neutral. It has to take care, also because it's a very solid, very performing. And if you have problems and a country exiting, clearly the contagion effect would be very strong. And so the temptation also in the German society is when you do something wrong, you are on your own, and you have to correct yourself, correct your behavior in order to stay in. And that's part of the instinctive reaction. But it took some time, and I remember in 2010, when we started discussing the Greek problem, it was very difficult for the German political elite in Berlin to understand the concept of contagion and why it would be a problem if a country left the euro area. You have also to take into account that Germany is not a country which is financially very sophisticated. I mean, the basis of the economy, the Mittelstand, is self-financed. The financial center is far away from Berlin. The stability of the Deutschmark has created an economy which is not so dependent on the financial market and the financial system. And so at the beginning of the crisis, there was a tendency by average Germans to say, okay, if the Greeks don't want, let them go. And it took them some time to realize that the contagion would be huge, and the political implication also will be huge. Now, coming to Cyprus, we have an election in Germany in 6 months, and there is a problem within the opposition party, the SPD, which has supported all European proposals by the Chancellor. They have always voted in favor of packages. So it's very difficult to campaign against Merkel while having voted all the proposals that Merkel made in terms of bailing out other countries. Then comes Cyprus, and Cyprus has this problem of money laundering, Russian depositors, banking system which is not very transparent. And that's where I think the SPD took the opportunity to say, okay, we will vote, but we want to put on conditions, which is to start clean up this banking system, which is not in line with our standards, and so having a tough stance with respect to this specific issue. So I don't think that what has happened in Cyprus suggests any change of policy of Germany vis-à-vis Europe, but it is an attitude, I think, to be tougher with banking systems which are oversized. Remember that Germany was very much in favor of the Tobin tax. So the view that banks have to pay their share when we have a crisis, which I think is common to the US also. I mean, it's a general feeling that, you know, taxpayers should pay if also the creditors pay. I think this is part of the understanding. And of course, it's difficult in Greece because the size, in Cyprus, because the size of the banking system is so huge, and the deposits, of course, they're all deposits. Funnily enough, the banks don't have bonds; they have deposits, which is a different type of animal to tax. But ultimately, there were no better alternative, I guess.
Would you like to follow up on that, Matt?
Yeah.
Next question.
Briefly contrast the Asian currency crisis with the current European crisis. During the Asian currency crisis, both Europeans and Americans were first to point out, let the free market take care of this. It'll be painful, but that's the way to do it. And now you look at the US in 2008 and Europe now. I haven't heard the word free market in years. Can you please comment?
Matt, do you want to?
Well, I mean, you know, there are everybody has their double standards. Right. I mean, as I said, I think, you know, crisis is actually shown in Asia as well as in Europe, and to a degree in the US, I mean, is actually healthy. I mean, I think it does get the politicians to really think about the future and forced to act. I do think that this is a difficult moment because, as what I alluded to before, you're talking about some real sacrifices, and that's where I think then the free market suddenly doesn't seem to be so free in the eyes of those that are actually paying the price, and that one of the things that we're, you know, again with a demographic change, which Asia didn't really have to confront in the crisis, its crisis, but you know is accompanying what's happening in Europe and the U.S. That you're trying to actually find a way of, you know, supporting a more senior element in your public and your population. At the same, because you've made these promises on entitlements at the same time that, you know, if you draw away the support for the universities and R&D and all that, you're actually undermining your future. And you know, there is going to be, I think, this tug. I mean, this is an argument that's going on in the U.S. I mean, and one of the points on the conservative side, which they've been making, is about the future and what kind of future you're going to provide your children. So I think it will be, you know, I do think it will work itself out. I think here's the importance of also moving more into growth paths. So you actually can do a little bit of both. But I do think that in the end that, unfortunately for those who are counting on some of the promises from government in terms of pensions and health care, that probably a certain price is going to have to be paid.
Would you like to follow up on that?
No, I mean, I don't draw the same conclusions. I think I don't want to be confrontational, but in Asia, the crisis led to a lot of resentment vis-à-vis the IMF. because it was said the IMF is too intrusive in trying to change the society and the way in which the adjustment has to be made. And it led to trying to avoid in the future relying too much on the IMF, so building up these big buffers of reserves, which I think was not the right attitude, because there were some fundamental structural changes to make. I think Europe is more willing to recognize that there are structural changes to make. Of course, people are not happy about the austerity, and they are not, and there is a tendency to blame it on the IMF. But in the end, the austerity that Europe has to go through is a result of not having made the reforms earlier. Had Europe done, and had Italy, for instance, done the reforms in better times, we would not have to confront the kind of imbalances we have and the kind of adjustment we have. And funnily enough, within Europe, and that's one of the issues in Cyprus, countries want the IMF to be in. They want, in spite of European Union being some kind of political system integrated, much more than Asia would be, they want an outside independent assessment on whether that is sustainable or not. And the IMF said, above 10 billion to Cyprus, that's not sustainable. And I think this allowed Europeans to say to Cyprus, we can give you 10 billion, the other 8 you have to find it in some way, either to privatization or to taxation. So there was an independent assessment which was made, which made it easier, I think, to have a dialogue with Cyprus, which of course wanted everything to be financed. So I think in Europe there is still a relatively positive attitude vis-à-vis the IMF and vis-à-vis the need to structure reform. And I think, actually, I always say, look at Asia. I mean, they didn't like the IMF. In the end, the IMF came. They changed. Now they are the strongest economies. If you look at those countries which went through an IMF program 10 to 15 years ago, it's Brazil, Korea, Indonesia, and Turkey. All these countries are much, much stronger than Europe today. So going to an IMF program, in the end, is not so bad. You should recognize that. And so it's painful. You blame them, but in the end, you come out stronger. And so Europeans should be less fearful of going through all this pain.
Just to follow up on that point with the IMF, through the European crisis, obviously they've been viewed as a key partner for that independent view, and have been instrumental in Cyprus in terms of defining a cap on the size of the bailout. In terms of their view regarding the deposit haircuts, because it seems that they were also one of the driving forces pushing for that, and how you balance cutting small depositors versus those with over 100,000, the sort of deposit guarantee, which would seem to have pretty dire consequences on the Cypriot economy almost immediately, given how they've built it up over the years. How do you think the IMF's role in that plays?
Well, as far as I understand, this was a Cypriot choice. The balance of taxation between the lowest deposits and the highest deposits. And clearly what they didn't want is to tax too much the higher depositors, because they were afraid of a run on the big depositors, which were mainly Russians, and because the Russians were also trying to help on another side. And politically, this may be very, very costly. And in fact, the parliament voted against. Yeah. And I think Europeans said, please don't touch the law below 100,000 euros, because that's commonly agreed in Europe. That's where insurance, deposit insurance works. If you hurt these guys, the contagion, the psychological contagion to the rest of Europe will be very strong. The alternative is to create contagion with the Russian depositors, which maybe are less important to the rest of Europe and more important to Cyprus. But they have to make a choice, and they made a choice, and they made the wrong choice, because the parliament voted against. So now the risk is that we have to keep, they have to keep banks closed for another day until they find a solution, and this is going to go on television, and this is not going to be very nice in terms of creating an atmosphere whereby the solution is at the end of the road.
Any more questions? Right at the back.
I have two questions. One is a more general one. Dr. Smaghi, you mentioned about taxation of capital, and yesterday Peter Thiel mentioned about perhaps we have too much globalization. And I was thinking, those two themes put together, could there be an argument for, reducing sort of heavy capital movements and sort of reducing the effects of globalization so that there's potentially less capital risk, contagion risk, etc. And also one directed question to Dr. Smaghi about more Europe, which is next month there'll be a new party launched in Germany called Alternative für Deutschland. And do you think they'll just be a blip, or do you think they might actually have a serious effect on the results?
Well, maybe you have more inside information about German politics. I just want to say on the second question that there was a party launched, the Piraten, which was an inspiration for the five-star movement in Italy, and it didn't last a long time. The Freewähler in Bavaria also did not have a big success. I think I cannot forecast what this new party will do, but if you look around Europe, you cannot not be struck by the fact that you go to the Netherlands and there is an extreme right party. You go to Austria, so look around Germany, in Austria, in France, in Italy, in the Czech Republic, everywhere there are extreme parties. In Germany, there is no extreme party. So you may like Merkel or not, but she's been able to maintain, in her own party to avoid extremism and to maintain a country which is still traditional right and left. And she's likely to win the elections in September. So I think she's going to be the only leader which will be voted again together with President Obama during the crisis. I think there is no other leader in the advanced world which has been reappointed, who has been able to win an election, or very few exceptions, I think. Maybe the Estonian president, which, by the way, went through a very tough austerity program. So it's very difficult to get reelected in a crisis like this. And I think if she gets reelected, that's really a sign of leadership, which requires, of course, in a country like Germany, which is strong, to negotiate in a very subtle way to avoid giving the impression that you're bailing out everybody. On the taxation issue, I mean, that it's clear. I mean, capital is more mobile than people, so it's much more difficult to tax. But we are living in a world in which if you tax too much labor and not enough capital, you have redistributive effects, which in the end become political issues because capital does not vote, but people vote. And so how to square this circle is not that easy, I think.
I would just say in defense of globalization, I mean, when you think broadly about what's happened in the past couple decades, where you've had globalization really flourishing. I mean, you've really opened up so many opportunities, and when you think of the number who climbed out of poverty and so on, it's unprecedented in human history. So you need to keep that in mind. I mean, obviously there's some downsides, but it's overall been a very positive story, particularly for this region.
Okay, I'm afraid we're just about out of time. We've obviously touched on some of the key issues regarding the political situation and the difficulty in seeing our way out of that. So thank you very much. I'm sure there's lots more questions. Thank you very much.
Thank you.